Well, hello there. My name is Mark Albert, and this is my good friend Bucky. Bucky is a dwarf rabbit. In fact, it's my daughter's rabbit. And before I go any further, there's a shout out to Karen there, because Karen is a friend of mine who loves rabbits like no one else in the world loves rabbits. So rabbit is awesome. And the reason Bucky is with us today is because if you take a look at Bucky, Bucky is soft, cute, and cuddly. And we're going to talk about collateral mortgages, and in my opinion, collateral mortgages are not cute and cuddly. But Bucky is. So there's a difference. This cute and cuddly gives you the warmth, exciting feeling. In fact, my daughter will be cuddling with Bucky for extended periods of time. But the collateral mortgage is not cute and cuddly. If you're familiar with the penguins of Madagascar, those guys are cute and cuddly. But the collateral mortgage is not cute and cuddly. And I explain that a little bit here. We're going to give Bucky a little bit more lettuce. Come on over and see your lettuce, Bucky. Get off my paper. There you go. Good, Bucky. So, I got here from the government website, from Budget 2014 from the federal government. And in it, I went to the section called Supporting Families and Communities. And actually at this time, this is in the government archives. So I'm able to find that. Bucky is very excited to know about collateral mortgages. So they said here, in terms of raising financial consumer awareness, so raising financial consumer awareness, they said the government will continue to raise public awareness about the cost of and alternatives to payday lending and other high interest rate lending products, collateral charge mortgages, and bank powers of attorney and joint accounts. And so, I find interesting here is that when the government, the federal government is talking about consumer financial awareness, to make the consumers aware of something, in the very same sentence that they're putting payday lending and other high interest rate lending products, they throw in there this collateral mortgage, which is called a collateral charge mortgage. So what is that all about, and should it be concerning to us? They went on to say, while many consumers continue to choose a traditional mortgage to secure their home loans, many are increasingly choosing collateral charge mortgages. And I think the reason is because some of the lenders, some of the banks and credit unions, for them it's a lot more profitable of a product, and so they're offering that product instead of maybe alternatives like the traditional mortgage, the conventional mortgage that we would be used to. And so there's a growing number of people who have these mortgages, and the government felt it important enough to add it in their budget in 2014 because of the concern they had. So I went also in the archive to the Government of Canada, and there's something I found here. It's called Voluntary Commitments by Banks on Collateral Charge Mortgages. And in the government's action plan, the economic action plan, they called on banks to enhance disclosure to consumers of the costs and consequences of collateral charge mortgages related to conventional mortgages, better equip borrowers and understand the impact of them. And so I just wanted to explain a little bit about what it is here. So if we have, here you go, thanks Bucky. So we got numbers here. So let's say someone buys a house and the appraised value of the house is $500,000. And let's say the mortgage that they need is $200,000 because they have enough equity or they have enough to put down on the house. So traditionally, what the bank or lender would do is they would register a lien against the house for $200,000 because it's a secured loan, this mortgage. But what the collateral mortgage does is they will register a higher amount. So let's say this is registered on the collateral. They register a higher amount. So let's say $400,000. So all of this between $400,000 and $200,000, they're just holding a lien on the house. So that equity is not available for anything else. But they tell you that there's flexibility so that if you need more money beyond this mortgage, we can give you a line of credit or some other thing for a higher amount. And so one of the challenges comes here is when someone who came to me and they had this product and they didn't know they had a collateral mortgage. And they went back to their bank, who was holding a lien against their house for a higher amount, and they said, you don't qualify for any more credit because of the stress test. They were in a difficult situation. And so that person came to me, and being that I'm part of a brokerage, I was able to get them a second mortgage typically, but because that the bank they were with was holding a lien against the house, registered all of that equity, there was no room in the equity of the home to help this client with a solution, a simple solution that would have helped them in a tight situation. So that's one disadvantage for that particular client. So the collateral mortgage, they can actually register up to 125% of the value of the home. So they could actually register, in this case, they could register a much higher amount. And the reason they would do that, and they don't always do that, but the reason they would is so as the value of your home goes up, then if you need additional mortgage or line of credit type product, instead of refinancing, you could just go through them, and that'll work like that. So that's that. So going back to the government of Canada, they're very aware that this is a consumer product that the consumer is not very educated on. That those mortgage professionals that are selling them these products aren't fully transparent in terms of what the product is all about on the positive and negative side. And so they say here is the consumers require sufficient information in order to be more clearly understand the costs and consequences of a collateral charge mortgage related to the conventional mortgage. And so the government of Canada said here, they said, when banks offer residential mortgages, they will provide consumers, is what they're supposed to do, they will provide consumers with comparative information that will help them understand the difference between the collateral charge mortgage and the conventional mortgage. So an educational piece that shows the pros and the cons of the two is what they require them to do. And this goes back to 2014. And it says here, banks are to commit to providing both general and specific information in a manner, this is what I like, that is clear, simple, and not misleading. But the challenge I see is I've had a number of people come to me and they have this product already and they're in a bit of a pickle and they need help, but there's very little we can do to help them because they're very much locked in and tied into this product right here. So in terms of the negatives on this product, and I think I would say to you, if you're working with a mortgage professional, ask a lot of good questions. Ask a lot of good questions in terms of the equity in your home, in terms of how much is going to be registered against the house. What's the lien size going to be? And that's an issue because if your equity is all tied up, then to other creditors, it may appear that you're overextended from a debt perspective, and it may be difficult to get other type of financing. And in a mortgage situation, a second mortgage is very difficult. So the way they register this collateral charge is done differently than the traditional mortgages. It's done in a way that you really can't transfer from this lender to another lender. So at the end of your term, let's say you're in a 5-year term, at the end of that term, you cannot transfer. So you basically, there's a lot of high fees to cancel that. So at the end of your term, there may be a lot of high fees. We're talking thousands of dollars to cancel that mortgage, to get out of it, and people don't like that. And also, so on the transfer, it makes it very difficult. So it's difficult because of the type of charge that's registered against your house, and it requires a lawyer to take that off, which is very expensive in this situation. And so it becomes very difficult to transfer. So people get very frustrated in that whole experience to transfer. So that's some of the negatives. So I would just say, if you're working with, if there's a product that you want because you want to have that ability and that flexibility, that's fine. But ask good questions and make sure all your questions get answered. Best thing is to write down questions before your appointment and things like that. So listen, I really appreciate your time, and if you like this type of video, subscribe below, and don't forget to like the video. Thank you very much. And Bucky, I appreciate your help too. You've been fantastic. All right, bye now.